Okay, hello and welcome to the Walker Webcast on HUD multifamily housing. I'm Susan Weber, your moderator. On today's webinar, we will be bringing you the latest news from HUD, and our FHA finance experts will provide an overview of the trends they are seeing. I would like to welcome our FHA Group Head, Sherry Thompson, our FHA Chief Production Officer, Stephanie Wiggins, our Director of FHA Underwriting, Ken Buchanan, and our Head of FHA Servicing and Asset Management, Corey Cooper. The team will discuss market fundamentals, HUD policies and operations, including a conversation about forbearance, underwriting, closing, and more. Thank you for joining us today, and now I will turn the call over to Sherry.
Sorry, Susan, I had to unmute myself there. Thanks everybody for joining and welcome. Here we're committed to providing solutions to our clients' problems at hand, and we know right now some of your problems revolve around rent payments and operational concerns, as well as the current challenges at play. So as Susan said, the purpose of today's call is to help give you some guidance and updates on HUD processes in these areas. HUD has recently provided us guidance in the areas of inspections and debt service reserves, as well as forbearance that we'll be discussing with all of you today. And in addition, we wanted to tell you a little bit about what we've been doing. It's been quite a whirlwind of a month for all of us. We moved the whole company virtual, and my team has been working closely with industry stakeholders and associations and HUD to provide market-based recommendations, which is ensuring the sustainability of the HUD financing programs and continued access to liquidity. We've continued to engage, process, rate lock, and close transactions throughout this crisis, and we've been actively participating in industry discussions on the topics we're going to discuss today. We really appreciate you joining us, and we'll hope that you'll find this session informative. As Susan said, we will leave time for Q&A at the end of our presentation. But at this time, I'd like to now turn it over to our subject matter experts. Stephanie will start with a discussion of our current market conditions. So go ahead and take it away, Stephanie.
Thanks, Sherry. Good afternoon, everyone, and good morning to those joining from the West Coast. For the past decade, the multifamily sector has been fairly insulated from the market dynamics that have impacted other real estate food groups. We have enjoyed strong, consistent performance supported by solid fundamentals and a supply that could not keep up with demand. And even with the commencement of the current unprecedented crisis, the sector's performance remained positive through the first quarter of 2020. And now, here we sit with COVID-19 in full effect, and our way of doing business and living our lives impacted for the foreseeable future. With 1 in 7 Americans out of work and economic turmoil as evidenced by the stock market's plummet, the multifamily industry is struggling to get its arms around the immediate and future impact of this crisis on the apartment market as a whole. And while the direct impacts will be measured in the months and years to come, it is becoming clear that the demographics that have supported our industry for so long are at risk. With jobless claims at an all-time high, reduced incomes are expected to drive down household formations, which will impact demand. This is an altogether different set of headwinds than experienced in the Great Recession, which ultimately resulted in displacement of homeowners and bolstered rental demand for more than a decade. Prior to this crisis, analysts and economists had already started the conversation and concurred that the real estate cycle was maturing. They also agreed that multifamily was the outlier as demand for apartments remained strong with one group or another, whether it was singles, couples, working families, students, all consistently seeking apartment units, whether driven by the economics of living in a high-cost market or by choice. If you study the trends over the past decade, these groups have continued to drive demand as they are replenished by either younger generations or, like me, empty nesters looking to give up the lawnmower for a Metro card and trendy restaurants. And in the meantime, the U.S. supply of rental units has not kept up. Another factor that has continued to drive apartment demand is that home purchases remain unachievable for many. According to the National Association of Home Builders, only 63% of new and existing homes sold in the fourth quarter of last year were affordable to families earning the U.S. median income of $75,000. And according to the Out of Reach report, of the 40 million rental households in this country, 50% of them spend more than 30% of their household budget on rent, which qualifies them as cost-burdened. And 11 million of these cost-burdened households earn less than $20,000 annually, which is near the poverty level. And for them, there are only 4 million rental homes available. These statistics underline the national housing affordability crisis that we all know about. And with COVID-19 related unemployment, this crisis is likely to worsen. We are optimistic, however, that the lack of supply will continue to present opportunity for owners and investors in existing properties, as well as in the new construction space. As rentals remain critical to the fundamental mission of HUD to create strong, sustainable, affordable, and inclusive communities, we at Walker & Dunlop continue to engage, process, rate lock, and close transactions throughout this crisis. We are deeply committed to keeping up this robust pace, as it is more important than ever that industry leaders and HUD continue to work to ensure that lower and middle income households and renters by choice have a place to call home. And the markets agree. Investors continue to have an appetite as they bet on the long-term viability of this sector. To illustrate, all-in interest rates have returned to pre-coronavirus levels, wiping away the volatility that was experienced in the weeks following the declaration of emergency. And as a financing program that is designed to be shelter in any storm, HUD's countercyclical program continues to be a fantastic option to finance multifamily. And with record low interest rates, HUD's inherent benefits are in high demand despite the challenges posed by COVID-19. Thanks so much for your time, and please continue to stay safe. And with that, I will turn it over to Ken Buchanan, our Director of Underwriting. Take it away, Ken.
Thank you, Stephanie. So this situation has evolved quickly over the last 2 months. HUD has been focused on adapting to new business practices and continue to process and close loans. In early March, HUD was first focusing on working remotely. They were able to transition and have all staff working remotely quickly. This was helped by the fact that most HUD employees already had laptops and were familiar with teleworking. Once staff was situated, HUD began to focus on the core underwriting and closing process. They realized that flexibility would be critical, but they also needed to focus on the potential risk associated with the COVID-19 pandemic. One of the first areas that HUD addressed related to site inspections. Very early into the pandemic, it became apparent that multiple inspections, the lender, third parties, HUD, that are typically required with a HUD transaction were not prudent or possible. In general, HUD is offering flexibility, and in most cases, they are deferring inspections until after an application is submitted, with the understanding that HUD will require the inspections to be completed prior to the issuance of firm commitment. There are some waivers available for newer properties that are available. One area that we are continuing to work closely with HUD leadership and our third parties is on leveraging technology for remote site inspections. This would utilize technology and allow on-site staff to take pictures, videos, share information that could be utilized by our third parties, the lenders, and HUD in order to meet the needs of the inspection process. While this is not formalized yet, this is an area we're focusing on and hoping that one silver lining of this is some of this would get integrated into the process after the COVID-19 pandemic and allow the inspection process to be even more efficient than it is today. On the underwriting front, HUD does understand that the COVID-19 is likely to have significant but short-term impacts on the multifamily projects. Therefore, they're going to continue to underwrite deals on a stabilized basis, but they are going to implement some mitigants into the process, primarily as it relates to a debt service reserve. During this time, we will be collecting additional due diligence from our borrowers focused on occupancy, collections, and operating expenses, and we'll be tracking that closely. But again, HUD is expecting that there will be some short-term dips here, but we'll continue to underwrite on a more stabilized basis. For the actual mitigants, for existing HUD deals that are refinancing through either the Section 223A7 or the interest rate reduction loan modification program, these are already HUD insured, and by lowering the interest rate, actually benefit the projects. There are no debt service reserve requirements or additional mitigants in place for these projects. For refinances, on a market rate transaction, HUD will require a 9-month debt service reserve. For affordable transactions with new tax credits coming in, HUD will take a look and have us analyze the reserves that are going to be in place from the tax credit investors. To the extent that those reserves are available for borrowers to utilize during this time period, we can credit that towards that 9-month debt service reserve requirement. The projects that HUD is more focused on are the affordable projects without new tax credits and without any project-based rental assistance. For these projects, HUD will require a 12-month debt service reserve. For projects that have project-based Section 8 contracts that cover over 90% of their units, there will not be any debt service requirement. For new construction projects, while there's not formal guidance issued from HUD yet, based on conversations and discussions with HUD staff, HUD is not as concerned about the long-term viability of these D4 projects, given that the units will not come online for 18 to 20 months from this time, hopefully when we're well past this pandemic. The concern really revolves around construction delays. This is something that we will continue to monitor, and it could require some additional mitigants in the form of increased operating reserves to cover that time period. On the closing process, this is an area where HUD has historically required in-person closings. They've quickly adapted to do closings by mail and electronically and are leveraging that. And again, this is something that we hope will stick going forward. There are also some other challenges related to local municipalities and recordation being able to take place, but we've been able to work successfully with our council and with our partners and make sure that there are alternatives to keep deals closing. So in general, HUD is adapted very quickly and put some prudent loan requirements in place that will help mitigate this risk. So with that, I'm going to turn it over to Corey Cooper, our head of servicing, to discuss forbearance.
And I'm going to go off mute. Okay. Hello, everyone. I'm going to provide a little bit of detail on the relief available to borrowers experiencing hardship related to the COVID-19 emergency. Over these past weeks, we have been working closely with our peer groups and with HUD to obtain guidance, and I'll speak to each multifamily and healthcare separately, as these are being treated differently by HUD, and therefore the available relief in place differs. First, I'll speak to multifamily. Here I'm going to touch on 3 potential forms of relief: forbearance, suspension of reserve for replacements, and the use of reserves to cover debt service shortfalls. HUD issued Mortgagee Letter 2020-09 on Friday of last week, introducing guidance for multifamily borrowers specifically. The multifamily letter provided for formal forbearance guidelines, and these are very much in line with the CARES Act. It provides for the temporary relief of principal and interest payments for borrowers experiencing operational or hardship, financial hardship, or operational hardship as a result of the COVID-19 crisis. This will come in the form of an initial period of 30 days relief of principal and interest payments. For a maximum total of 90 days, you're entitled to 2 extensions upon application. These requests will require backup in the form of financial evidence of hardship, certification, and a formal forbearance agreement. They'll have to be repaid in no less than 12 equal installments over a 12-month period or earlier at the borrower's choosing. All programmatic and escrow requirements remain in place, so your standard taxes and insurance, MIP, and reserve for replacement are still required during that period. With that in mind, the mortgagee letter also provides for the relief of reserve replacement deposits for a period of time upon request by the borrower. HUD approves those requests, so those have to be submitted to them, but HUD has indicated that they will approve them. They can also request a release from reserve for replacement with appropriate backup directly to the account executive. And again, HUD has indicated that they will be approving those liberally with appropriate backup. We're recommending that all of our borrowers request suspensions of RAR, and in the event that they have a balance of over $1,000 per unit, which is the minimum requirement, that they first seek a release from the R4R before they request a forbearance. A couple of things on forbearance. Please do keep in mind that just as the CARES Act provides relief for tenants, you must pay attention to your local and your state restrictions and not initiate or complete any evictions for non-payment during that time. Also want to point out that cash flow distributions during this time are prohibited during the forbearance period and the forbearance repayment period. There's a lot of detail. Please be sure to contact your HUD account executive for further detail. Now, a couple of more points on forbearance. We are actually reaching out to our HUD account executives to obtain additional clarification on a couple of items, so we may well see additional guidance in the coming weeks. In addition, HUD has stated that they may be releasing their own form of forbearance agreement, which would differ from the one we're using now, which is the HUD-approved MBA form. That in mind, I will now turn to the lien side of the business, which is governed by the Office of Residential Healthcare Facilities. To be clear, I'll touch on forbearance, delegated approval, and non-delegated approval. On the matter of forbearance, HUD ORCF has indicated that they do not believe that the CARES Act applies to healthcare transactions. Therefore, at this time, there is no statutory or programmatic ability to request a forbearance on a lien transaction. We are working with advocate groups to obtain additional clarification, and we believe that that will be coming in the coming weeks. In the meantime, ORCF has authorized delegated approval under certain circumstances for us to release escrows with the appropriate backup evidencing the hardship related from COVID-19. These will come in the form of your operating deficit escrow, debt service savings, and reserve for replacement in that order. In the event that a loan is in risk mitigation or that the balance remaining is under the $1,000 per unit minimum, those requests will have to be approved by ORCF. We have had numerous conversations with our ORCF executives, and they are poised and ready to approve and review those requests. Again, we are hoping that we will receive additional guidance very shortly on the lien program and other forms of relief. But in the interim, please contact your WD loan servicer or HUD producer, and they will provide additional guidance. So I will, with that, it's a lot of information. I'll pass it back to Sherry.
Thank you very much, Corey. As Corey said, lots of information there. I know it was a lot of meaty stuff. Your account execs here at WD stand ready to help you answer questions, to provide that information individually, and to help you walk through forms as needed to get everything you need. We're going to now move to a Q&A for a few minutes. Our first question from the audience is around forbearance. Question one is, does forbearance of loan payments apply to multifamily construction loans? Corey, would you mind taking that one?
On the healthcare side, as I said, construction loans, same as with permanent, there is no guidance, there is no authorization for forbearance. On the multifamily side, the mortgagee letter specifically states that the loan must have attained final endorsement. So construction loans will not be eligible for forbearance. That said, I think we need to think of the two processes or two parts of construction. So you've got the active construction phase, And we're seeing HUD getting really creative with what they're doing. We're still processing a lot of draws. For those instances where, and we'll inevitably see them, where suppliers are delayed, where there are restrictions on labor, we're going to be looking at time extension change orders. And as Ken indicated, I'm sure we will receive additional guidance in coming weeks. On the lease up side, we will be looking to suspend reserve for replacement requests with HUD approval and be tapping the escrow's working capital initial operating deficit with obviously with HUD approval and the appropriate backup evidencing hardship. But that's the extent of relief available at this time.
Let's take a look. We've got a few more questions coming in right now. The next one is relating to current market conditions. What is the current outlook for interest rates today? Stephanie, can you give a little more color here, please?
Yeah, absolutely. So typically, I would look to our deeply experienced trading desk, right, or my crystal ball to answer this. But my desk has walked me through some really good data out there from, the biggest investment banking houses and analysts that are studying the markets all the time. And as we look to the responses that have been given by their economists and analysts in April, we continue to be optimistic about the trajectory and stability of interest rates. Right now, or at least earlier this morning, I haven't checked in the last hour or so, the 10-year U.S. Treasury is at 61 basis points. And economists that responded in April versus March have amended their projections of a year-end 2020 benchmark from 120 basis points to 90. And all are in agreement that this benchmark won't exceed 1% until the second quarter of 2021. Concurrently, the expectation is that investor spreads will continue to compress as we all look for signs of economic growth fueled by GDP and inflation. To illustrate, as we look ahead to economic recovery projections, economists are advising that with a V-shaped recovery, the Treasury will creep up. But with an L-shaped recovery, they expect the benchmark to remain low for the foreseeable future. But even with a V-shaped recovery, it is still a fantastic time to transact, with borrowers getting a fantastic deal on their cost of capital. And we stand ready to provide all borrowers with the best execution and pricing for their transactions.
Great to hear. Thank you, Stephanie. Definitely.
You're welcome.
The wind is in our sails right now for where the interest rate environment is. We've gotten quite a few questions coming in on credit related to Ken. I'm going to ask a couple probably of you. The first came in is, should we be concerned about potential ramifications related to forbearance requests?
So we haven't received formal guidance from HUD on this, but we will be tracking the request and obviously letting HUD know. Again, HUD hasn't issued formal guidance. I think as long as borrowers are following the protocols and acting in good faith, HUD definitely understands the situation that we're in and the impact it's going to have. So I think if best efforts are made and people are doing the right things, it shouldn't have long-term impacts. But we will know more when HUD issues formal guidance.
Okay, great. Here's another, I'm going to try and, forgive me, I'm looking at these, combine a couple together. A couple people are asking about construction rules, if there's any changes to construction starts or any change in process for new 221D4s.
So for the change in process, no, it is business as usual for D4s. I will say, again, HUD has not issued formal guidance, but again, based on conversations with HUD staff and through the industry, the primary focus is on the construction phase, as most of these D4s would be delivering units 18 months from now. So there will be a heightened look at the construction term, and if there were to be delays in construction, is there sufficient funds in the initial operating deficit to cover that type of delay and the additional construction interest that would be associated with that. The other area, there will be certain markets that may be more impacted by this than others, markets that rely on energy or tourism or other markets that were already a little iffy in HUD's opinions. HUD will probably be taking a closer look at those markets as they make decisions.
Great. Thank you. I'm going to stay with you. There's a bunch coming in on the credit side. So another one is, will availability of HUD loans become scarce? And if so, will that mean higher debt service coverages to qualify or lower LTVs?
No, I think HUD's purpose has been to be counter-cyclical and step in when there is a liquidity crunch. That said, HUD is always prudent and may adjust some of their underwriting parameters. But right now, based on current guidance, HUD is anticipating this as a short-term issue, and that's why they're solving for it with a debt service reserve escrow that can be held and ultimately released to the borrower, as opposed to increasing debt service coverage ratios or reducing loan to values. Again, HUD wants to underwrite on a stabilized basis for now.
Okay, great. Let's see what else is coming in. Forgive me, we're getting a bunch of these questions in and they're coming in quick, so I'm trying to manage them as well. Will the COVID-19 crisis slow down or accelerate HUD approvals? Ken, maybe you, that's probably for you too. We're going to keep you busy today.
Okay. So I would say that in general, HUD has adapted very quickly and it is business as usual. Obviously, the situation is fluid. People are working remotely right now. Policy is being drafted and issued in real time. So there's going to be some amount of delays. But everyone, and I'm on all the industry calls and talking with HUD staff routinely, they understand now is their time to step up and help with this pandemic and this crisis and provide affordable housing and financing. So while there could be some slight delays, we are continuing to get firm commitments and rate lock and close deals on a weekly basis. And HUD has, in my opinion, done an excellent job in managing through this in a very difficult situation.
And Sherry, I would just like to add, I would agree with that on the construction servicing side and on the servicing and asset management side. Folks are very responsive. They realize this is a crisis and they are ready and willing to step in.
Great, thank you. Yeah, I should have said, please, everybody jump in as needed on here to give a collective. Okay, another one's coming in and we have a few more minutes. We're going to answer a couple more. Question is on the healthcare side. Is HUD still taking in new 232 applications? We have a pretty robust pipeline of 232s. Ken, I'll give that one to you, or Stephanie, maybe you. One of you guys can answer that one too.
We are continuing. HUD has not issued any mandate to not accept new construction healthcare loan applications. Obviously, similar to the on the D4 multifamily side, I think it would be similar considerations. But we are, while we see more refinances under the Section 232 program, we are still open for business on new construction side.
Fantastic. And another question came in on the debt service reserves. I think we went over this, but maybe a little more detail on the reserve requirements for the various multifamily products and how long we expect those to be in place, please.
Sure. And I may not have mentioned the reserve requirements will be in place. There's a two-part test for the debt service reserve and for it to be released. It has to be both tests. The first is that it's 6 months from the time of closing, and the second would be 3 consecutive months of programmatic debt service coverage. So both of those tests are met. So if you have a project that closes and never falls below programmatic coverage, in 6 months, the reserve would be released to the borrower. If you have a project that has programmatic coverage and then drops in month 6 to below programmatic coverage, but then returns in months 7, 8, and 9, the reserve would be released in month 9. And to quickly run through them again, if it's a market rate refinance, it's a 9-month debt service reserve. If it's an affordable refinance that includes new tax credits coming into the deal, it's a 9-month debt service reserve, but we can look at what other reserves are held by the tax credit investor. And this is key, the borrower must have access to those reserves during this time to cover some of the debt service and other expenses. And if there are reserves available, those can be credited towards that 9-month, which would reduce the reserve we would require. For affordable refinances without any new tax credits, these are projects that HUD is concerned about. A lot of these are very affordable projects. They're not rental assistance, and that is a 12-month debt service reserve. And then finally, for project-based rental assistance, with over 90% of the units covered, there is no debt service reserve requirement. And similarly, for currently insured HUD projects that are doing Section 223A7 or interest rate reduction loan modifications, there is no debt service reserve requirement.
Great, thanks. We have time for a couple more. One question which I don't think we have a complete answer, but it's been asked a few times, so I'll try and address this, which is around the SBA PPP loans and if you're allowed to use them to pay your mortgage or how you can use them in conjunction with the HUD product. There is some conversation still in the industry on figuring out the best way to mesh the PPP loans with any kind of governmental mortgages. So that there is more to come on that, and when we have that information for you in a more consolidated format that gives direct answers on how we can utilize them together, we'll be sure to push that out. I think there's probably maybe time for one more question. Ken, I'm going to push this one to you as well, but other people can jump in here, which is, do we anticipate any higher vacancy underwriting requirements right now, given the virus and the current situation? I think I'm saying that right. Do we anticipate any higher vacancy for debt service? Yep.
No, we do not anticipate having to underwrite to higher vacancy. Again, HUD is really looking to for us to underwrite on a stabilized basis. So if the project was operating very well and the market was strong leading into this, the purpose of the debt service reserve escrow is to carry and fill that gap during the time of this pandemic, and with the assumption that things will return to a more normal state. So we will not be reducing occupancy or increasing vacancy.
Okay, and I lied. There's one more, which is a pretty easy one, so I'm going to take one last question if you guys are all okay with that. Will site inspections be waived for 223F during this crisis?
So site inspections will not be, there are a few exceptions for some waivers of site inspections that require HUD approval. This would be for newly constructed projects. But what HUD is really doing is deferring site inspections to, again, allow time when we're sheltering in place and inspections are just not safe or practical to go back and complete those inspections at a later time prior to issuing HUD's firm commitments. That said, I know HUD is continuing to evaluate and look at this. They have been issuing pretty much weekly updated frequently asked questions that address a lot of these topics. And so the policy continues to shift as it needs to.
Yeah, thank you, Ken. I would add to that I think the things that Ken talked about virtual inspections, and we are definitely monitoring our pipeline and trying to make sure that we're using our own technology too to make sure that we're really well positioned as the economy opens back up and the pipeline opens back up to make sure that we are able to manage the and help HUD manage the workflow that will be coming from backed up site inspections, as well as continuing to process new business through as it comes through. Unfortunately, we've run out of time today on Q&A, but if we didn't get your question live, please know that somebody from our team will follow up individually with you. And just in summary, on behalf of our whole team, I want to thank you again for joining us today. We know these are really challenging times for all of you, and there's lots of complex issues. Our production staff is really well versed on the guidance we described today, and as your partners, we really stand ready to help you guys. Don't hesitate to reach out at any time to discuss questions about today's material, help you want in evaluating new business transactions, or anything else that's on your mind. As Stephanie highlighted, HUD is countercyclical and it's open for business. So please take good care and have a great weekend, and thank you again for joining us.